what I want to get across is like this whole process in the region, you can really see it working. It's escalating, right? And what do I mean by that? What exactly what I said at the intro. What started in FX has moved into sovereign debt. It's now moved into commodities. And the next stage, we'll see what happens, right?
Right.
I talked about those five key kind of ceasefires agreed to in this region over the last 3 to 4 years. And what I want to call out here is look in the Japanese yen. So background here, Japan as an economy is dependent on importing energy resources, right? And the status quo is that it's really been heavily reliant on oil and gas imports from the Middle East. So you would expect it to be very heavily impacted, especially as the last stop on the shipping routes from Persian Gulf all the way up to um, what is it, the Korean or Sea of Korea, etc. My point here, early on when we saw the first three of these ceasefires in this little recent era, Israel, Hamas, Gaza 1, Lebanon 1, and then Gaza 2, those were all events on the chart. And what they stand out, like what's happening heading into them as this instability is growing, right? War is on in the Middle East. Um, the yen is weakening versus the dollar. Up in this case, the Japanese yen versus USD chart is yen weakening. Down is actually strengthening. Um, so what you see is whenever for these first three, one of these ceasefires was announced, it was viewed by the FX markets as like a risk, like not risk on, risk off in the equity beta sense as we typically defined it, but it was a risk off sense in the terms of like global supply chains, energy commodities, all of that. Like from the whole system order standpoint, whenever we got one of these ceasefires, you would see the yen rally and what's been a secular weakening or sell off in the yen every time we would see one of these ceasefires up until I would say this past fall when we saw the board of peace. I call it like Gaza Fiend, like that was your third ceasefire event. Right now, I expect that that board of peace arrangement to hold. Right? Why do I say that? Well, we've got several allies, the GCC countries, all involved as stakeholders. It's stamped, signed, sealed, and delivered as like with the UN resolution authority, all of that behind the process. So that should, in my mind, kind of tie up the longer steady state arrangement for the Gaza issue, right? We'll see if that holds or not.
Yeah.
All right, but what we saw on that one, the yen stopped rallying on the ceasefire or the peace deal announcement, right? That was a big change, right? And so now where we stand, US around one, we're at another one of those. It looks like similar to the first three, we might be in a scenario where the announcement of the ceasefire was your kind of precipitating event or headline that allowed this macro market to break through resistance, if you will, and then the yen strengthens off of that basically on the let up of pressure in this whole geopolitical system, environment, everything, upheaval taking place. We'll see if that one stands like with the follow through, which way the yen trades or not here. But my point is, if the first three and then this latest one, the U.S. Iran deal, falls in line and exhibits the same pattern as the Board of Peace, it's telling me as kind of a portfolio manager involved in global macro markets, that this pressure has moved out of just the foreign exchange markets and as kind, its release valve, it's moved somewhere else, right? Now we go, what's the next step in that chain? That's where we'll get into sovereign debt markets, right? So those same events here, this is the US Treasury 10-year, same thing. We see it doesn't account for all of the major reversal points, but going back to 2023, it's a lot of them, right? So the Gaza 1 ceasefire, the Lebanon 1 ceasefire, the Gaza 2, all of those were precipitating events, right, for 10-year yield, which was, in a rising rate environment as kind of these markets can sense out the instability, right? It ultimately is working. It trickles its way into supply chains,
Right.
right? And that's just evidence and obvious, right? When you think about this latest one with the Strait of Hormuz, right? It's like, oh yeah, duh, this is
Oil will be
impacting global
import.
supply
Yeah.
chains. Yeah. So, but you saw those first three, they led to reversals, right? Board of Peace did kind of did. It was mini, but it wasn't on a major. It wasn't like a major trend change. We'll see what happens with U.S. and Iran. But notice Board of Peace. It didn't get worse, right? At the very least, right? It didn't break out from there, and what was kind of a secular rally in 10-year yields from basically June to October of last year, 2025. We'll see what happens with U.S. and Iran. I want to call out here, though, everybody, the dooming head, the black pillars talking about de-dollarization, U.S. government, treasuries going bank, all of this. We're going to hell in a handbasket. Okay, but if you look at this chart, right, 2022 was definitely a thing, right? One of the biggest bond market sell-offs, like top 2 to 3 in the history of the United States, right? So it was a big event and it represented something, right? My point here, though, for this stage in the game, trend this chart, right? And if I was doing it, I would draw a line. Yeah, you can draw a channel here, downward sloping on yields. My point here, yields are steady to slightly down, like wanting to trend slightly down for the U.S. Treasury 10-year. What that's lightly telling me in an environment where all sovereign debt, all fiat debt is going to be fundamentally kind of reshaped coming out of this. U.S. 10-year is holding up better than its peers, right? We could the only like when I say peers, the G7, the post World War II coalition members. This is the this is still the safe thing from the perception of that system itself that sits at the core of the system. Um, con- uh, Contrast that with France's 10-year oat, right? And why do I pick on France? Well, besides your Bund, it'd be like your number two uh, risk-free sovereign debt asset of choice for the
European
European
retail.
banking
Yeah.
system, right? And this is where I think you see a real problem. Starting with, look at the slope here. It wants to trend up and to the right, which in the yield framework that means bond prices are down. So this is where like the problem is starting to really reveal itself of where the weakest points in the system are as we head into the latter innings of this chapter in the the game that never ends, essentially, right? So if you look at the ceasefire events, Gaza 1, oh, what is that? It's not the top tick, right? But it was, if you think about the break, right? If technical analysts out there want to think about when a Head and Shoulders breaks, right? This is the most obvious setup for it. But once you break the neckline, what you're looking for is a retest event and then a failure and then a down move. This isn't a, I didn't, there's no Head and Shoulders setup here, but it's that similar thing. You got a trend line here. The asset is already trending down. You get the event that you head into the retest and then you break lower. My point here, look at the three: Gaza 1, Lebanon 1, and Gaza 2 ceasefires. Each one of those, well, Gaza 2 is literally the top tick, and then you get the reversal off of that. But Gaza 1 and Lebanon 1, those ceasefires were the precipitating events to confirm the the rallying and oat yields on of those two events. So
Right.
what this is saying is European debt markets really needed to see stability on this geopolitical shakeup. And when we say that, what I think what you're looking at here, I'll get in and describe the most recent two. But I think what they're saying is the European debt markets are desperately clinging on for the status quo or something that doesn't shake it up too much to hold for the sake of both financial markets, balance sheet solvency, all of that, but also just resources and commodity access, right? These economies need to know where they're going to get their resources from because Europe really doesn't have much for the way of energy commodities or yeah,
Yeah.
hard
Shut down their
commodities in
nuclear
general.
reactors. Yeah.
Yep. So you see that same pattern. Even the Board of Peace, in the case of French debt, was kind of a relief event that allowed this pressure on yields to let up. I think we saw the same thing with the U.S. Iran one ceasefire announced on Tuesday. You saw the pressure valve let off some steam from the upward pressure on OAT yields. And now, just to bring in a little more technical analysis, I drew the yellow line here on the 3.5% yield level, which is really showing itself as a line that someone, and when I say someone, like ECB, the the European banking system, all of that, would like to see defended. And you notice that one, two, three, four. Like you've had multiple attempts knocking on the door. The Iran like really blew through. So I mean, this is like Hodor in Game of Thrones, man.
Yeah.
Someone really needs to hold the door here. And
Spoiler alert.
yeah, this oh God, what a sad scene. Anyway, um, someone really needed like it's like a boxer late in a fight. Like they saved by the bell here. Um, so I think you're looking at that. Now you look at this spilling into the commodity markets themselves. And we went from the point, this is CL1 or the WTI first, Gaza 1, Lebanon 1. They don't matter at all, really, in terms of you know, identifying a point of reversal on um, uh, front month WTI prices, right? Which tells you from the domestic U.S. economy standpoint, and maybe even some exports, as the U.S. has become, somewhat of an energy exporter. I mean, the largest producer. I don't know where we rank in terms of exports, but we are the number one producer. Basically, the capacity constraints, like we were fine in terms of our domestic production was essentially holding up in terms of like supplying into domestic demand, right? But I think with Gaza too, that ceasefire on January 15th, right before Trump was sworn in or the 47th administration began, the fact that we got that reversal point there, higher high on the chart, it's starting to tell me if I'm looking at this in post, it's like, oh, that's where some sense of commodity tightness was starting to bleed into the system. And what do I mean by that? Like we've seen in the last week or so, WTI flipping to above Brent in terms of oil pricing in spot markets. We talked about this last week. What does it mean? Since basically 2023, over half of the actual oil cargoes delivered into the Brent settlement venue um, have been sourced from WTI Midlands, right? So it's coming from the U.S. Ultimately, cargo trips, tankers, they load up in a chain, they deliver into Northern Europe. If the spread is positive there, the paper market that is Brent, because there's no actual physical production, like by and large, happening there anymore. That's positive. It's profitable from paper producer or the paper standpoint in that European nexus, right? What we're looking at, I think, with Gaza 2, starting on January 15th, that's your first signal that this whole like global supply chains connect all the distribution, marketing, all of that in the energy complex is starting to show things are getting tight, right? So when we get um, the headline, oh, we've got some resolution, looks like we're going to find a steady state for the Gaza scenario, all of that. Energy markets responded pretty, I guess, sharply to that news as what was starting to look like a key pressure point was showing some relief. And then you get the Board of Peace. Also comes off on, it's not a higher high, but it is just a local top. And then that shows its head with what we just saw in the last week and have been riding for the last, I'd say, 5 weeks now since the Iran events opened up on February 28th. Surge in oil prices, 100 to 110, back to similar levels they were at when Russia incurred into Ukrainian territory. This is showing now that this broader reordering that I argued at the beginning has really been underway since, I mean, you can go back even further, but probably 9/11 was the uh, the first domino that started all of these events falling in order. This is spread over. Now it's in the energy markets themselves, right? So we've got a big kind of process. This whole thing wants to change into a new state where we can refine some sense of stability. But as I said up front, got a 2 week window here. There's a lot of vested interests who want to see the status quo prevail because their wealth, status, all of that, businesses, they're tied up in the continuation of the system. The thing has to change one way or the other, right? The status quo cannot hold. But right now, for the next 2 weeks, this is a key moment where one side or the other is going to prevail, take some ground, get a beachhead into the Iran situation, which I mean by that, what's being represented here with the 47th administration, or
Right.
the other side can kind of win. They can't win, but winning here is preventing uh, your competitor from making forward progress. So it's going to be a really interesting window here these next 2 weeks.